Well, just moments ago, the IMF hiked its forecast for global growth, but also says an economic recovery will be sluggish. So what does this mean for the Fed and central banks around the world? I'm joined now by a man with more than 2 decades working on monetary policy. He's Vincent Reinhart. He's a resident scholar at the American Enterprise Institute and a former director of monetary affairs at the Fed, joining us from Washington, D.C. And Vincent, great to talk with you as always. I know you went through some of the headlines coming out from the IMF, boosting their global outlook for 2010. Are you surprised by that or no?
Not much. All they're recognizing is that the free fall is over, that market economies are resilient, and so that they've adjusted a little bit up 2009 and 2010. But it's very sluggish. We don't have the foundations for durable economic recovery yet, and the IMF forecast recognizes that.
Right, and Vincent, I mean, on that note, you have been quite critical of the Fed and Treasury officials for not having done the right things during this crisis. So in many ways, though, wouldn't you look at this report and say, well, at least they've stabilized this? I mean, there's some vindication in here in this report, no?
Sure. What we have done is we've spent a lot of resources to make sure the really bad outcomes don't eventuate. The very long, contracted depression in economic activity. That's a success. You got to give credit to monetary and fiscal policy officials for reacting quickly and strenuously. What you might wonder is, could they have done it better? And I think in both cases they probably could have.
Hey, Vince, this is Peter Cook here in Washington as well. I want to get your take on one aspect of the report as I've been going through it as well, and that has to do with monetary policy and the recommendations from the IMF. The IMF saying in this report, monetary policy should remain supportive until growth resumes and deflationary risks dissipate. Remaining room to cut policy rates should be exploited, while non-conventional policy measures to support credit flow should continue to be explored. Do you agree with that?
Yes. So I think they're sending two messages. First, they're telling the Fed Reserve and the other central banks that are doing unconventional policy, keep what you're doing. And second, they're sending the signal to the ECB, there is room to lower policy rates. Fact is, we don't, in the U.S. at least, have efficient fiscal stimulus. We need to get better traction. We haven't made progress or significant enough progress in dealing with the losses at our financial institutions. So there is room for monetary stimulus. The issue about the exit strategy is it's not time to exit now, but we should talk about it to reassure investors that when the time comes, the Federal Reserve has a plan to do it.
Okay, and we've heard some, Vince, it's me again, we've heard some talk about what an exit strategy would be. So in your view, in order to right the wrongs of what we've done in the rescue packages we put in place, I mean, what would a proper exit package be?
So the Federal Reserve's got to shrink its balance sheet, and it's got to do it in a fairly dramatic way.
But I think they have shrunk their balance sheet, right?
Yeah, that's mostly come because as markets improve, some of their facilities have gotten expensive, and so we've gone from $2.25 trillion to $1.78 trillion in terms of the overall size of the balance sheet. But remember, that balance sheet is still probably twice as big as necessary to get a positive federal funds rate, that is a non-zero federal funds rate on average. So they got a lot of shrinking to do in terms of the amount of reserves outstanding in order to get back to more usual policy. But they shouldn't do it now. Now's not the time to exit. It's the time to talk about exits to reassure investors.
Vince, Peter Cook again. Let me ask you one other aspect of this report is the forecast for emerging economies for China and India. Their upgrades there from the IMF in terms of their economic output, specifically on China. Just reading from here, 8.5% in 2010. Do you disagree at all with their assessment that things are going to improve even more in China and India?
So I think particularly with regard to China, it's a recognition that they had a more efficient fiscal impetus. They did it quickly, and they did it with a lot of support to particular capital spending, lots of government spending. That's the advantage of having somewhat more of a command and control economy. You can get the engines of spending going if you control a lot of the levers of policy. That's not exactly the way to run policy here, but it does tell you if you get fiscal stimulus right, you can have an effect.
Okay, Vincent Reinhart, thank you so much for joining us again. Always great to see you. Vince Reinhart of AEI, the American Enterprise Institute.